Hi everyone. Today it is my pleasure to be with Kari Vatanen, Chief Investment Officer of Veritas Pension Insurance.
Hello, it's nice to be here with you, Florian.
Thanks, Kari. Today we're here to discuss a very interesting theme, investing past the pandemic, with three different investment horizons, the shorter term, the medium term, and the longer term. Today's topic is the medium term horizon. The question I would like us to raise and answer should be the following: how do we see the investment world change once we put this pandemic behind us? Kari, last time we talked, you mentioned the risk of higher rates, duration-related assets potentially being at risk, depending, of course, on the pace. What about the medium term now?
Okay, I'll start with my graphs first. The graph on the left there. Rising inflation expectation, they have lifted up longer rates, and at the same time, yield curves have steepened. But still, unemployment is at higher level after the pandemic, and that implies that both monetary and fiscal stimulus will still continue to support real economy in US. On the graph on the right, higher economic growth and steepening yield curves, they have started factor rotation in the market, and I expect that to continue further. It means that relative overperformance for value and size factors will continue. At the same time, growth and momentum factors will underperform.
Okay, thank you. That's very interesting. I would say that we mostly agree with what you just described. Maybe it's important for us to go back to the origin, to the trigger of the rotation we are also expecting, and this origin is more likely to be not inflation itself, but an inflation surprise. Within the way we think of dynamic investment in markets, one key concept for us is inflation surprise, so the fact that inflation surprises you to the upside. And currently, what we're seeing is that inflation expectations remain quite low among economists and market participants, which opens the door to a surprise. The chart in front of you shows the typical patterns, the typical risk performance adjusted to risk pattern that you could expect, or you could have expected, I must say, over the past 20 years, across a large bunch of traditional risk premia on the left and alternative risk premia on the right. So you will recognize among the ARPs the pattern that you just described, especially on the momentum side, on the value side, I'm sorry. But what is also something very important for us is to try to look past this factor rotation among equities and see that maybe this rotation triggered by inflation could be larger, affecting a broader spectrum of alternative risk premia, as you can see on the right, notably positive performance coming from trend following strategies, positive performance coming from some of the carry strategies, and it's very striking to see their performance since the beginning of this year. It's all the more important as if you look at the chart on the left, you will see that a lot of traditional risk premia could be put at risk by a significant revision of the inflation scenario. So let me just summarize things that we just discussed now. You're expecting on your end a strong growth leading to a steeper slope, leading to also an overall factor rotation beyond what we're currently already seeing in terms of financials, but also the value factor, notably some correction on the momentum side. On our end, we don't disagree with that. But we think that if inflation really surprises to the upside, we could see a bit more than that, in the sense that we could see alternative risk premia that have been posting actually quite negative return last year, do a recovery, essentially trend following and some of the carry strategies. Is that a good summary of what we just discussed, Kari?
Yes, sounds good.
Kari, thank you very much for your time today. Thank you very much for your input, and bye-bye.
Thank you, Florian. Bye.